All right. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker ZIM, ZIM Integrated Shipping. Very interesting company. I'm very excited to add it to our watch list. It is, as you can probably guess by the image here, a shipping, container, and related services company. Before we get into the company specifically, start as we usually do, taking a brief look at our watch list of other companies that we've done valuations for, all of which you can find live streams that I've done in my catalog for. Noticing a few companies moving up and down through here. Last week I had noted that LPX had been rising a little bit high up in here. I actually did trim back a little bit of my expectations on the company, but it still appears to be a relatively high valuation on our list currently, as well as a lot of my own companies have been that I currently own, which are these purple ones here, have been moving upward this week. In fact, I bought a little bit more of Interfor and Smith & Wesson, both of which I've been buying pretty regularly, as well as bought a little bit more of Hibbett, one that I've been buying for some time and had for a while, as well as Turtle Beach, a company that I haven't bought for a while, but I have owned for a while, and I recently had done some updates on my valuation of that since its most recent crash, but I decided to pick up a little bit more of share of that for myself here. I noticed that Sleep Number has been rising pretty high on the list. I did take a look at Sleep Number again to double check my numbers on it, and while I'm pretty confident of the numbers I put in place here, it still doesn't really fit for my portfolio for a number of reasons. One having to do with their poor management of shareholders' equity, and my belief that the plan in place for management to have their goals aligned with shareholders' interests, while I think it's commendable and done well in a certain sense, I think is done at the detriment of some of their balance sheet numbers. So it's a company that, while I think is good in some regards, isn't one that I personally want to own. But anyway, that kind of covers where what our watch list currently looks like as of right now. Coming down and taking a look at the schedule of economic data that's going to be released in the near future, you can see that throughout this week we're expecting goods orders as well as pending home sales and GDP and corporate profits coming out this week. Very interesting to see the GDP second quarter second estimate coming out this week. That is that it's going to be possibly a revision from the expectations for the GDP numbers that were released previously. It's possible that it gets revised upward, and it's also possible that it gets revised downward, both of which would be interesting to see how that affects markets overall, as well as the corporate profit numbers, which would be very interesting to see on their own. So before also getting into ZIM Integrated Shipping, I wanted to point out that I also released a new video, a non-live stream video over the last week, this Learn to Invest video about Aswath the Motoron, which I'd recommend people to go check out. It's done pretty good in numbers, at least as far as how we typically do, but I did want to recommend other people go look at that if you're not fully aware of who Aswath the Motoron is and all of the resources he has available for investors. Oh, and also before we get into ZIM Integrated Shipping, it would be really helpful if those who are watching could give us a like and subscribe to the channel. Be very much appreciated. Likes help attract more viewers to the channel, and if you are not already subscribed to the channel, you should. That way you get notifications whenever we go live or whenever I release other video content. Also, it would be very cool if you could join the Discord. The link is in the description below, as well as it is the pinned comment in the chat. You can find that there to join our community of investors that we like to have chats having to do with our own portfolios, investment ideas, and discussions of major investors and other market news and things like that. So you can join that in the description below. So now getting into ZIM Integrated Shipping, as I said, it being a shipping and container company, very interesting industry that's experiencing lots of turbulence in this last year. Hey Nukit, how's it going? Welcome to the stream. I gotta say, and I kind of wanted to personally thank you. I certainly noticed you watching a lot of my content yesterday and giving us lots of good comments and feedback. Very much appreciated. It was pretty much like every couple hours it felt like I was getting a new notification from you, so very much appreciated. Anyway, so ZIM Integrated Shipping, founded in 1945. It is an Israeli shipping company. They do their business entirely in United States dollars, so we don't really have to do any currency conversion, but it is an Israeli company, and that does have some factors that we'll get into as to how that relates to their business operations. I have their main websites listed here, including their SEC page, because they are in fact listed on the New York Stock Exchange, regardless of the fact being an Israeli company. It is a foreign listing. The current CEO, Eli Glickman, He was elected to be CEO in 2017 after having joined relatively recently prior to that, being a part of some other shipping companies and other technology companies in 2015 and prior to that. Yeah, very much appreciated, man. We've actually been getting some really good spike in viewers in the last few days and last week or so. Decent spike in new subscribers as well. And really just a few of our last few streams, as well as that video that I released over the weekend, have all been doing really, really well. So I'm really trying to keep the ball rolling as best as we can. Anyway, as I had already mentioned, they're into the marine shipping industry. The customers are really too varied to mention here. They have lots of customers, and then suppliers. They also have a pretty wide varied set of suppliers, although it's worth noting that specifically the supply of actual container ships themselves and also port management being the most important factors for the people in their supplier base, though I couldn't really get specifics as far as like larger companies in that industry to name here specifically. Competitors, a little bit easier to name more specifically, AP Moller Maersk and Hapag-Lloyd being two really large players in the shipping industry. Between the two of them, I'm pretty sure they make up more than 30% of the entire market share. And then MSC and COSCO being other players that make up, between the four of them, about 50% of market share of worldwide shipping. Market share being measured as a total of the TEU instrument that you will see lots of measurements for in their numbers, which is a 20-foot equivalent unit, which is basically a shipping container measurement. They recently reported their numbers, so they're expected to report again in mid-November, and the call is expected to be around the same time. In their presentations, I couldn't really find revenue guidance, but they did give EBITDA and EBIT guidance for the next year, expected to be about 8 billion in adjusted EBITDA and 6.5 billion in adjusted EBIT. Revenue for the analysts, however, they do have 13.3 billion in expected revenue for this year in 2022, according to 7 analysts, but then expected to drop then to 9.2 billion, according to 8 analysts in the year following that, with their EPS going from 43.82 this year, 43.82 compared to their current share price. That you read that right. In fact, that's probably one of the reasons that many of the people who do watch this stream will probably be watching, is because it's a very, very talked about stock right now because of the fact it's trading basically at a PE of 1 or just around that range. But yeah, 5 analysts are expecting to have EPS approximately of $43-$44 this year, and then to drop to about $14 to $15 next year, according to 8 analysts. So a huge drop in the EPS. That PE of 1 is definitely not expected to last. And then even the next year numbers themselves probably won't last. We'll get into that in a little bit though. They have a trailing 12-month dividend of $27.10 per share. So a very, very huge dividend, including special dividends. Being that they recently IPO'd only in the last couple of years, they are a little bit fresh to the capital markets, and so kind of already starting off with a dividend record is a little bit interesting and not necessarily the most conservative of paces to keep with them, but it is expected that their dividend will ebb and flow with the profitability of the business. They themselves said that they expect to pay out at least 20 to 25% of net incomes moving forward. Their forward dividend, as according to the current quarterly dividend that's expected in the next quarter. In fact, the ex-dividend date for it is I believe in like the next 2 to 3 days or so. So technically there's still time to hop in on that, which itself is 1/4 of this, being $19 per share. So I just annualized the next most recent quarter out to get this annualized number. It's not necessarily that the next year is actually going to be $19. It's possible this one quarter is the current amount and that they may drop it again right after that quarter. But either way, if you analyze that out, it comes out to be 39% for a forward dividend rate. And then I did not find information regarding buybacks in their presentation. It is reported that they have 33% of their shares held by insiders. We'll get into some of the specifics of that because it's a little bit tricky to lay into. I went over to Ticker Terminal to find out some of the specifics regarding that. You can see that Keenon Holdings holds about 25 to 26% of the shares, and Danos Corp has about 5 to 6% of their shares. I'm going to start with Danos Corp because that's the easier one to make a conversation about, which is to say that Danos Corp is another major shipping company, specifically one that's based in Athens in Greece. So there, it's a little bit more of a cooperative agreement between the companies to own each other's shares. So you can kind of argue that that particular share is a little bit more steady and not likely to go anywhere. They're not going to be selling that into the market to anytime soon. And then the Keenon Holdings, I had to kind of go a little bit more specifically into their 10K to find not their 10K, their 20F to find information about that. But that is actually a holding company that's effectively controlled and operated by the Israeli government itself. So this is basically a section of the business that is owned by the Israeli government, effectively to make sure that the Israeli government has access to large amounts of shipping containers in the event of a national defense event of some sort. So when it says that there's 33 to 34% of shares held by insiders, effectively those shares are truly removed from the total float. And as a result of that, it also is reported that they have about 33 wait, that's the same number here. Did I write the same number twice? I must have. Jesus, where did I just realized that? I don't know what I was thinking when I wrote that. It's 43. Yeah, 43. I don't know why I did that. 43.99 is the percentage of the institutions of their shares outstanding that's listed here. But if you take out the amount of shares that is removed from their float, this 43 to 44% actually would jump somewhere to the range of like 60 to 65%. So of the total float. So effectively, institutions do have a controlling share of the float. They just don't have a total share of the entire outstanding amount of shares. And you can see the same thing reflected in the short outstanding, which is that there's 6 to 7% of the shorted shares outstanding, with only 9 to 10% of the being out of the float. And the float also has a short ratio of 2. The short has a short ratio of 2.65 days, so it's a relatively short time frame for the coverage of the people who have the shares shorted. Also, the short-term volumes, 3-month average volume being about 4.45 million shares versus the last 10 days has been a slightly higher volumes of 4.71. So basically, the higher volumes of the most recent time frame, not to mention the relatively high short ratio and the higher insider ownership keeping a larger amount of the shares off the float, could argue that this is perhaps a relatively good time, statistically speaking, to be entering into the shares, assuming the valuation is amenable, which we'll get into that more specifically. So I'm going to actually close out a few of these things specifically here. So before we get into the company number specifically, I want to cover a few of the details that they have in their investor presentation right here. They cover some of more of the details related to the guidance that they gave out and also the dividend policy that I already covered. But really, I kind of want to come down here to some of the more things related to their business. For example, first they show the volume breakdown of the in thousands of TEUs, their geographic by trade zones. As you can see, a pretty large section of their business comes from more consistently over the 4 periods here. You can see Pacific, though with larger sections of the growth growing between the intra-Asia sections of their business. Also, you may go down a little bit further. They show some of the trends in the overall business over time, showing different metrics of port congestion in the North American ports. So you can see that over the last year, how we've had really large spike ups in port congestion, leading to really high freight rates, which is at the basis of their revenue base, which we'll get into when we look at their revenue projections, and also showing the difference in the departure time frame for cargo levels. And then there was also this other graph that they showed down here showing the total weekly demand of volumes that being put through the shipping, and comparing that overall to the US weekly inventory to sales ratio, showing that even as the inventory to sales ratio has climbed in the last year, showing the bulking up of inventories at retailers in general, that actually hasn't brought down the total demand in the shipping containers themselves. So with that, we will get into some of the into the segmentation of the business, which is at the foundation of the valuation itself. Coming down here, them being part of the marine shipping industry, that gives them an unlevered beta of 0.9 before adjusting for leverage, and a sales capital expectation in the most recent year of 0.88, and adjusted net margins on average for the industry in the most recent year of 17.11%. So pretty high margins for the industry on average over the last year, though that makes sense considering how great of a year that they've had. And ZIM has had much higher margins than that, but we'll get into comparing them to their industry once we're taking a look at my expectations for them for their margins. Now, I kind of did my calculation of their equity risk premium a little bit differently. Normally, I do it based off of revenues and or production locations of the assets, but in this particular case, they didn't give me disaggregation of the revenues by geography. They gave me specifically just the disaggregation of the total freight that they carried. So I did a calculation of the equity risk premium based off of that, and I ended up with a risk premium for them of 5.19 before adjusting for the most recent period, which brings it up to 6.4. And then their debt to equity ratio, it comes up to be about 61 to 62% after adjusting for total debt, including lease liabilities, which ends up being about 3.6 billion or so, at a weighted average interest rate of 5% and a weighted average maturity of 7 years. So not the greatest of interest rates, but not necessarily too bad of an interest rate either. Weighted average maturity of being 7 years is pretty good because that means it's past the period of our total time frame. Hey, what's up, Jess? Yeah, I was definitely a little bit interested in this one. The numbers looked pretty interesting. Not to mention, I figured since so many people were very interested in this company, it would be a pretty good one to do just for the channel's sake. Definitely very, very complicated, but that's part of the reason, you know, sometimes it's worth looking where it's darkest, you know, so kind of where we're at. So yeah, with the debt to equity ratio of 61 to 62%, that brings the beta I'm using for the company up to 1.38 after adjusting for the leverage. And then that itself brings the cost of equity up to 11.89%. So just under 12% for a discount rate, pretty decent discount rate for the company overall. We'll take a look at their financial history, which is pretty interesting to say, starting with in 2012 all the way up through, I'll say up through 2020. You can see that they basically had a large ebb and flow of the revenues over the entire time frame, but it basically went from 3.9 billion to 3.9 billion end to end. And then only in 2021 did we have this huge spike, 169% jump in revenues off of the back of all the macro factors that we were just discussing. So really, it's a question of exactly where the revenues are going to go over the long run. I actually took this little kind of sidebar over here to seeing that the average revenues for those 9 years, not counting 2021, the average revenue ended up being 3.3 billion. And then the standard deviation during that time frame was just about $500 million or so. So yeah, pretty interesting to see that the standard deviation itself is only about 14% of the average. I was just kind of trying to get an idea of just like how non-volatile were their revenues on net over this period where they didn't really move. And yeah, you can basically just argue the revenues basically didn't really go anywhere. However, that is also off the back of the fact that they also had not IPO'd yet. With the fact that they IPO'd after 2020, it's just simply true that companies that are public companies versus private companies typically have better access to capital bases, which allows them to expand their businesses better. And as a result, they typically take up a larger share of revenue pies in the overall business sector. For example, it's something, I don't know, I remember the exact numbers of it, but I'm pretty sure it's something like 30% of all named businesses are public, whereas 70% are private. But I think if you reverse that, it's something like 70% of the revenues go to the public companies versus the other 30% going to the private companies. So public companies have like a massive overshare of the revenues relative to private companies. So the question, in my opinion, is not just a question of how much of the revenues are going to disappear because of the macro factors decongesting and starting to unfold and going back to normal, so to speak, but also how much of it will they manage to keep because of the fact that they IPO'd, like because of the fact that they have better access to capital, they should be able to issue debt and be able to take up market share relative to some of the other private players. And so my argument is that they probably won't go back to this 3.3 billion average that they had prior to that. They'd probably be able to stick some sort of upper point a little bit higher than that. Not necessarily too much higher, but higher. Yeah, a huge percentage difference between private and public companies versus the total revenue share. It's pretty dramatic, and it makes sense when you think about it, because public companies are run to be efficient. Private companies are run for whatever reason the private owners want to run them. They don't necessarily have to think of profit as the number one motive in the first place. Some people run companies for their own pride more than for profits. Versus a public company, it's a little bit harder to get away with that because eventually the shareholders will throw you out if your motive. They don't necessarily always do it super quickly, but eventually it'll typically happen. So, and then like I said, also access to capital, being able to issue bonds, issue more shares on the market. All that access to capital means that they have better growth avenues. Yeah, it makes sense. Public companies typically have larger revenue pools. Now, like I said, it's hard to say just how much that factor affects ZIM specifically, and even just the shipping industry specifically, because I'm talking about the entire economy as a whole. That's what the averages tend to look like. That's not necessarily what ZIM specifically is going to look like, or the shipping industry itself is going to look like on a whole. I don't know what private versus public averages are like in the shipping industry specifically. But anyway, so moving down further through some of the other financial information here, taking a look at their gross margins. That's something I kind of want to point out here because it's going to be part of how I'm going to think of where I think future net margins could possibly go, which is to say, if you look here, the average gross margin that they had prior to IPOing ends up being, actually have the calculation over here, ends up being about 8.3% versus the average gross margin they've had for 2020 and 2021 together is 46%. the difference between the two being about 38%, and then the ratio between the two being about 5.5 times. I'm going to use this ratio and this difference as partially some of my calculations having to do with margins, so I kind of just wanted to point that detail out now. Coming down here to the net income line, we can also take a look at basically the same thing for that, which is that the net income margin averaging from 2012 through 2019 is negative 5% or so. The average over the entire time frame, if we include both of the 2 years, ends up averaging about 1.4%. And then the average for the most recent 2 years since they've IPO'd is about 28%. So obviously a huge jump in margins in the most recent years since they IPO'd. But again, it's also at the same time as having these massive macroeconomic changes that have caused freight rates to go through the roof, as well as have relatively high demand. So the question is, where do we think all those things will go in the future? I'm going to finish going through all the financial lines before I kind of go through my methodology for having thought about where I do think that those things can go. Taking a look at their free cash flows over the time frame, because of the fact that they were not public, there isn't really too much to speak of in terms of total common payout and whether or not they were overpaying or not, but we can at least take a look at what the cash flows were like. For the first 5 years of the time frame, it was pretty negative, only having one positive year out of the 5 years in this particular year where the free cash flows to equity were positive. Just kind of showing the overall troubles that they probably had in terms of access to capital. You can see this with lots of companies prior to the IPO, is that they typically have very minuscule positive cash flows in any sort of sense if they're trying to operate anything more than a pretty stable business. If it's a pretty stable business, they might have decent cash flows, but if it's anything very cyclical, like shipping, for example, then you'll often see some pretty rough cash flows prior to IPOing. Now, obviously, they've had, like I said, super great cash flows in the most recent couple years, but that partially has to do with their ability to churn the most recent events into huge cash flows in the short run. But like I said, we don't really need to pay too much attention to their total common payouts as a proportion of free cash flows. It is worth noting that since 2021, in the most recent few quarters, they obviously had paid some really large special dividends, which are actually pretty huge amounts of total cash flow coming out of their business. As I had said at the start, 21.50 being the dividend per share on the trailing basis, and then they're currently expected based off of the current forward quarter. If you annualize it up, it ends up being $19 per share, though like I said, it very well may be less than that if the future quarters after the next most recent one are going to possibly be lower than that. Who knows? They haven't declared those dividends yet. But the point is the dividend rate of 30 to 40% is pretty ridiculous, pretty astounding, and is unlikely to sustain itself, either because the dividend itself is going to have to come down dramatically, or because the price is going to have to dramatically readjust to different factors of profitability. It's worth noting that whenever dividends are paid out, they do come out of the share price. So if you're getting a 39% annualized yield, that means it's about 10% for each quarter. That means when they pay you the dividend on the ex-dividend date, effectively speaking, the share price should drop about 10% just by proxy of the fact that cash left the business. Anyway, so moving down, also to taking a look at the returns on invested capital. Much like with the profitability of the business and the cash flows, they're going to be pretty ugly as long as they're super negative. So it is kind of hard to get a sense of what the actual returns on invested capital is like, because of the fact that the capital base itself had difficulty finding any sort of stable footing without having good access to capital. If we do take the average of the entire time frame that's available to us, it does come up to be 12%, but without having any sort of certainty in the consistency of those years prior to that, we can't necessarily rely on that number as some sort of signifier of what types of returns on invested capital they're going to earn in the future. So I'm really, returns on invested capital is not really going to be too much of a meaningful concept for us in our projections. Taking a look at their balance sheet, we can see that their balance sheet has obviously exploded, in particular in the last couple of years, much like everything else in the business. You can see, for example, the current assets for the years that we have prior to the most recent 2 years averaged around 600 million or so, and they didn't really seem to deviate too far from that over the entire time frame. Also, the total current assets during the entire time frame averaged about 1.9 billion, which also a little bit higher of a deviation of that. You can see that actually the assets were a little bit higher in the past, and they were trailing downward, relatively speaking, towards 2019, and only then did they start to explode upward after a huge increase, mostly in the current assets and the cash levels and securities. But also, in terms of that, also the liabilities, basically much of the same. The total liabilities for the period prior to 2020 averaging 2.1 billion or so, and that's basically the same level that they ended at. Also showing that they actually had relatively higher liabilities in the 2013 through 2015 period, which is very much in line with higher assets in 2013 through 2015 as well. So it shows that they basically had a little bit of a higher asset base back maybe about 10 years ago, and then they kind of were slowly eating away at the asset base over time during a period when the freight rates weren't as good and demand wasn't as good, also prior to having access to capital in the IPO. But ever since, obviously, their liabilities explode upward with that. You can see that the overall difference between the two, for example, in 2019, they had 1.9 billion in total assets versus 2.1 in total liabilities. So they did have negative equity in 2019, and then obviously ever since then they've had positive equity. Actually, taking a look at that in the shareholders equity line, you see the average shareholders equity they had from 2013 through 2019 was negative 160 million or so, versus it ending in 2019 negative 257 million, and that's pretty much in line also with the retained earnings as well. So yeah, obviously they've managed to build up their retained earnings due to the profits they had in the most recent couple of years. And in many ways, it's just a question of just if that retained earnings is going to be enough to sustain them through the next down cycle. That's really kind of the way we kind of got to think about this. It's not so much about if they're going to have a bad cycle. It's really about when and just how well they're going to manage their path through it. So coming down here to take a look at the sales capital ratio, one last kind of final thing we can kind of take a look at in our financial information. We can see that in the period prior to 2020, they averaged 2.59 or so, ending at 2.99, which is pretty interesting to see in my opinion. Relatively high sales capital ratio for such a capital intensive business. I have generally always said that companies with low margins typically have the high sales capital ratio, so it does kind of make sense from that perspective, considering they had such low margins. But considering the type of capital in this business, I really wouldn't have necessarily expected it to be that way in particular, because typically you see high sales capital ratios with low capital intensive business. So it is a little bit interesting to see that they had this relatively high sales capital ratio prior to their IPO, and even since their IPO, yeah, it's come down a little bit since then, but it hasn't like dropped super dramatically, though we could argue that that will have to shift over the time frame. One way of interpreting this is that perhaps that their sales capital ratio may have been significantly lower in the past during a better part of the cycle, and then as they move through the worst parts of the cycle, they shrank their capital base faster than their sales actually disappeared, and possibly creating a kind of artificially looking high sales capital ratio. That's one way you could possibly interpret this. But one way of interpreting it is that the idea that they must have a low sales capital ratio due to the capital intensity of their business is just not necessarily required for this particular case. And in fact, I'm maybe even more willing to lean towards that particular notion in this case, because I'm more trusting of the fact that a low sales capital ratio goes with a high margin and a high sales capital ratio goes with a low margin than I am with the other, I guess you could say, principle of that way of thinking. So with that, we've taken a look at all the factors for the historic history that is required for us to kind of think about the business in terms of what I want to do for the projections of the business. I did actually build a revenue model for my way of thinking about where the revenues are going to go for the business itself. Nuke, gonna watch the rest on replay. All right, later. Thanks, man. Thanks for all your support, as I said before. So coming over here, they did give us information on their TEUs carried, that being the 20-foot equivalent unit, cargo kind of effective unit that is used in the industry, as well as their average freight rates, and then that freight rate being translated into revenues from freight rates. They give this based off of their years, going back to the earliest I could find was 2017. So I built a little bit of a revenue model based around that from the numbers of 2017 through 2021, which is a relatively small period of time frame, but unfortunately those are the only years that I could get this information for. So the total amount of freight they carried in thousands through these years, you can see 2.6, let's see, it's in thousands, so that means it's gonna be 2.6 million or so, up through 3.4 million into 2021, growing at 10%, down 3%, being roughly flat, up 22%. So you can see kind of overall ebb and flow over this time frame. Now I'm kind of keeping with the same train of thought that I was doing with the other financials, where I'm kind of thinking pre-2020 and then since 2020, partially because that's the IPO, but also partially because that's when a lot of the macro factors started shifting underneath us. The average of the TEUs prior to 2020 was 2.8 million or so, and then since then it's been about 3.1 million or so. Which that's just the average of those two. And then the average has moved upward about 13%. So I just kind of wanted to think about that in terms of like overall. Obviously, that's just a 2-year average versus a 3-year average. It's a relatively small sample size, but again, like I said, we're limited with what we have in terms of information for this one, so I'm just doing the best with what I've got. Now they also give us the average freight rate for this time frame, which is about $1,000 in 2017, and it spiked up to under $3,000 in 2021, down 2%, then up 3-4%, up 22%, and then more than doubling in 2021. Doing basically the same thing, we take the average for the first 3 years and find that it's just under 1,000. Average in the most recent 2 years or so, just about 2,000. You can see it's basically about doubled over that time frame. And then the freight revenues is basically just the combination between those two factors, and then converted into millions, because that's just how I like to deal with my revenue numbers. So overall, you can see that the average of the freight revenues that they had being 2.7 billion in the prior to 2020 3-year average or so, and then 6.6 billion or so. So it's more than double. Keeping it relatively simple, this isn't actually equate to their total revenues. This is just the freight revenues, but it does equate mostly to their revenues. It's like 90% of the revenue. So it's close enough that I feel comfortable with kind of making my projections based off of that. I'm keeping it pretty simple. Best case scenario, we're just gonna go ahead with the average demand that they had in 2021. We're going to assume that demand sustains itself in the 5-year forward period. That's 5 years from now. We're going to assume that the demand that they had in 2021 will be the same. That's the best case scenario. Now, as far as the price in the best case scenario, we're going to assume the price is going to actually be the average of the 2 years, 2020 and 2021. So we're going to assume that it's effectively dropping from the 2,700 that it's currently at, down to, in 5 years time, again, that's in 5 years time, it'll be around 2,000. You might say, well, it should drop much more than that. Well, I would say, well, there's also inflation and things like that. We're talking about 5 years from now. This is what I think the freight rate will be in 5 years, about 2,000. And again, this is in a best case scenario. So best case scenario, 3.4 million in freight and 2,000 in as a price. That gets me to 6.9 billion or so in revenues in a best case scenario for 5 year forward from now. Worst case scenario, we're keeping much with the same sort of logic. We're going to say worst case scenario, demand is going to return to the pre-2020 average, which is about 2.8 million or so. And then the price, we're going to assume that it goes back down to the average freight rate that it had for the 3 years prior to 2020, which is just under 1,000. And if we calculate that back up, that ends up getting us to about 2.7, just under 2.8 billion in revenues. Again, 5 years forward from now. Excuse me. So anyway, those are going to be our revenue assumptions: 6.9 billion or so, or a little bit higher than that, to 2.7, a little bit higher than that billion in the 5 year forward period. Come over here to our projections. You can see I have that here, about 2.7 to 7 or so as the range, kind of tilting towards 5 a little bit. That gets me an expected revenue in 5 years from now of 4.65 billion in total revenues, which is down 56 to 57% from the 2021 levels. Now, as far as where I think the kind of the overall movements of it's going to be over the short term in the time frame, I'm keeping this part relatively simple. If you look at Yahoo, and I had already kind of quoted the numbers earlier, the average revenue estimate for this year, 2022, is about 13.4 billion, and next year it's expected to then drop down to 9.2 billion or so. Now, so for this year, I actually have the expected revenues basically going in because I have it going in a straight line down to this 4.6. That means the expected revenues is effectively about 9 billion. So I'm effectively skipping the 2022 year where it's supposed to go up to 13 billion. And I'm basically just going straight to 2023 where it's supposed to drop down to 9 billion. And in fact, I have it then going on a consistent line downward towards 4.65 billion or so in the 5 year forward period. And so you might say, well, why are you skipping the 13 billion or so? That's like a whole lot of revenue that you're completely skipping, as well as the profitability. That's just one way in which I'm being a little bit more conservative on this one, because partially my spreadsheet has limitations on what I can do in the short term, but then also that kind of gets into some of the assumptions we're doing about the margins. And so I'm kind of balancing some things out, and I would rather just skip 1 year of good revenues and get straight to where I think their terminal revenues are. And I feel reasonably confident about these assumptions I made as far as the longer term revenue model goes. So now getting into the margin assumptions. Now this gets back into what I had said before about the gross margins. If you remember from earlier, I had quoted the average gross margins for the most recent 2 years was about 46%. whereas the average margins for the 7 years prior to that had been 8.3%. The difference between the two was 37 to 38%, and then the scale between the two was about 5.5 times. So if I then kind of take those kind of ways of thinking, and I also compare that with the net margins as well as I also had the average margin for the industry last year was 17.11%. I had mentioned that as well. So their margin in the most recent year was 43.25%. That means that their most recent margin was 2.5 times better than the industry margin. Okay, so then with that assumption, I basically then take that and then subtract out the average margin that they had over the entire time frame, which is 1.4. I basically say, well, if they have 2.5 times better margins than their industry, what would their margins have been like in terms of a previous past stage, given that scale? And then I also compare that to the difference between their gross margins and their in the short term or the long term, and then subtract out the difference from the average of their short term margins. Basically, I come up with 3 different methods for approximating a potential long term average net margin for the company, which I have in these 3 right here. The average of which ends up being 4.5% or so. I ended up with about 5% in one assumption, 3.5% in another assumption, and about 5% in another assumption. So about 4.6% or so is kind of the best guess estimate I came up with for a potential terminal net margin that they could sustain over the long run, based off of the variability in their net margins versus their industry, as well as the variability of their margins compared to their gross margins. So with those, that's kind of going to be my baseline for my assumptions of margins. I have the midpoint kind of being roughly close to that. As I said, 4.61 was what I got. The expected net margin I actually have put in here is 4.26, so it's actually a little bit lower than this assumption that I came up with, being a little bit more conservative in another way. And I have the range going all the way down to 0.5, basically as close to 0 as I could get, because like I said, they have so many years of negative margins that I felt like I basically had to go to 0, but you can't actually put 0 in. And then I have it going all the way up to 7%, which is about 50% higher than the kind of assumption that I came up with, about 4.5%. So I'm assuming that maybe they could do 50% better than my assumptions was, and that gave me about a 7% point. So basically from 0 to 7% approximately is kind of the range that we end up with. The median being about 3.75. I tilt it towards 5 to kind of make it get to this 4.26%, which is a little bit lower than the assumptions I had in place. Now kind of thinking about what this does in terms of where its current valuation is, because it is a total crapshoot. I'll totally admit that, as far as like where one thinks the revenues and the margins are going to go for a company like this. But here I am making some pretty bold assumptions of it. So I kind of wanted to think about this. I was like, well, okay, based off of these assumptions, what would be, what does my net income look like in the 5-year forward period? And my expected net income with these margins ends up being about 200 million. Now it's worth noting that they currently have on expected basis with the debt assumptions I have, which I haven't actually covered yet, but with the debt assumptions I currently have, they have interest expenses of implied about 250 million, which means that, for example, if they had no interest expenses and they were to add on interest expenses, that would bring them into negative territory, which I think kind of in some ways simulates the situation they were having when they had difficulty sustaining any positive net margin prior to that, which is basically to say that they were being drowned in the current levels of debt they had without access to new capital. It's kind of a weird way of making an assumption about it, but it basically argues to me that I think that this 200 net income expected number that I have over here is roughly equivalent to assuming that they're going to increase their total revenues in line with the current debt levels, and then they're going to accrue new interest charges roughly in line with that. And then with that, like I said, I didn't actually cover it yet, but I do have debt assumptions with the current assumption being about 61 to 62%. I have it on a range of 5 to 95%, leaning towards 50%, which gets me an expected value of about 50%. So I'm assuming that their debt levels might in fact actually improve a little bit, having to do with the fact that they likely will have their market cap increase over time, with the fact that I find them currently a little bit undervalued on a debt adjusted level. And then the only other assumption that comes into that has to be made for the valuation to be complete is the sales capital ratio assumption, which, like I had said when I was covering the financial assumptions related to that, it's also just as much with the revenue margins, a little bit of a crapshoot. As I had made the argument for, you could argue that the sales capital ratio would make more sense for it to be below 1, but the fact that they're above 1 and had historically, not counting the most recent 2 years, relatively low margins, that would actually go relatively in line with having a high sales capital ratio. So for the terminal assumption, I'm going to assume that this kind of downward trend in the sales capital ratio will continue, but I'm going to assume that it doesn't continue so dramatically that it goes below 1. I have a range of 0.5 to 3 on an expected basis. It ends up being about 1.24, which is in fact lower than the 1.68 that they had most recently, but not so much lower that it makes them less capital efficient. Now, that's all the major assumptions that goes into a normal valuation, because the only other major assumption that I do in my valuations is default risk. And for most companies, that's a negligible factor that doesn't necessarily have as much of a bearing, or if it does, it only has a minor effect. Now, that's not the case, unfortunately, with ZIM integrated shipping. Even though they only have a debt to equity ratio of about 62%, they have such a huge amount of interest charge relative to their hairline margins that they actually are at pretty dramatic default risk. And obviously that's not true of their really high margins they had in the most recent year, but that is true of historically the margins that they had attained prior to 2020. And it is also equally true of the margins that we're assuming for them in the 5-year forward period. Even with a 4% margin, that was kind of why I was comparing the expected interest expense compared to their net margins. It's like their total interest expense that we expected them to have in the 5-year forward period is actually even higher than the net income we expect them to have, which is to say that small shifts in their interest expense could quickly take out all of that net income if it was not to be safe. In fact, for example, if you added back the interest expense to the net income, that would get you an idea of basically how much income they had left over prior to paying the interest expense. And if it's really only twice the size of it, that means that basically they're paying out half of their pre-interest income in interest, which is not a good place to be. So coming down to where we typically do the adjustment for default risk based off of the interest coverage charge, which is basically the ratio I was just talking about, you can see that on an expected basis, in the 5-year forward period, it's not even on an expected basis, that's actually just a simple average. On an expected basis, the ratio of pre-interest income to interest is really only about 2 times, which is basically what I was just saying there. Which means that unfortunately they do have a pretty significant amount of default risk. On an expected basis, I actually end up with over 4% per year. That's 4% chance per year that they simply will not have access to capital in order to run their business. That's not to say that they aren't earning profits, that they can't earn their business. It means that they won't have the cash on hand in order to pay their interest, because you may be earning a GAAP profit, but you may not actually have the cash on hand, which is why another reason, as I had said before, that companies that are public, that are part of public markets, typically having access to higher amounts of capital, and therefore have a better chance of survival and have much better chances of growth avenues. So they might be able to actually trim back this default risk more over time now that they've IPO'd, but in the meantime, for their first 5 years as a public company, they will still have huge, dramatic amounts of default risk here kind of naturally as part of the business. So with that kind of gives us our entire valuation. We can come over and take a look at the summary. Prior to me doing the full summary, I'll ask again, if you haven't already liked the stream, you're watching either live or on replay, please give us a like. More likes attract more people to the channel, and it'd be really, really appreciated if you would do that for us. And also, if you're not already subscribed to the channel, please subscribe to the channel. You'll get notifications when I go live, as well as when I release other videos and other content on my channel. And also in the pinned comment in the chat and also in the description below, you can find the link to the Discord, where you can join us in our community for the discussions we have about the stock market and other things in investing. So with that, ZIM integrated shipping. Very, very interesting company. US Treasury selling just over 3% now. Very curious to see if we can hold the line over 3%, since we had difficulty sticking the landing there prior and we did below it for so long, but I digress. Mature market equity risk premiums currently up to 5.22%, and the discount rate I come up with for ZIM integrated shipping after adjusting for company specific risks is just under 12%, 11.89%. The current expected for dividend rate annualized up off of the 1 quarter expected rate is 39%, as I had already discussed some of the complications with that assumption though. Their sales 5 years ago was 2.5 billion. In the most recent year, it was 10.7 billion, equating to a sales growth of 33% per year for the last 5 years. And then the sales capital ratio for the last actually that's actually the most recent year. I didn't do the last 5 years. It was really just the most recent year. But the most recent year sales capital ratio was 1.68 compared to the industrial expectations for shipping industry of 0.88. So as you can see, like I was saying before, a relatively low sales capital ratio. Returns on invested capital in the most recent year was 75%, which, as we also discussed before, is probably not likely to sustain itself in the future. It probably has to do with the fact that their capital base is probably not large enough to sustain their overall returns in the future. So either the returns are going to come down or the capital base has to come up, or some combination between the two. Debt to equity ratio currently is about 61 to 62%, including lease liabilities. And in the most recent year, that equated to just over 1% in default risk, relatively minuscule compared to their future default risk, but that has partially to do with the dramatically high margins that they had in the most recent year. Profit margins in the most recent 2 to 3 years on average has been 18 to 19%. Compared to the profit margins for the industry in the most recent year of 17%. As we had said, their most recent year margin was actually 40% and higher. So they actually had significantly higher margins than their industry on average in the most recent year. And again, you can see here a relatively high margin for the industry with a relatively low sales capital ratio, which seems to be reversed with the situation of ZIM integrated shipping. And that comes to profit in the most recent year of 4.6 billion. And that gives them the current sharing price of $48.67 per share. The probability distribution I'm using for the company is our pretty standard normal distribution. I'm not really tilting one way or the other with this one, partially because of my uncertainties and my own assumptions here. So I kind of just kept it as per the normal. But either way, I have revenue assumptions, a worst case scenario of 2.7 billion and a best case scenario of 7 billion. On an expected basis, I have it at 4.6 billion or so in the 5-year forward period, which equates to sales growth of anywhere from negative 24% per year to positive, or not positive, to negative 8% per year. On an expected basis, we see negative 15% per year. So yeah, pretty interesting to have a valuation that we're doing right here, where under basically every single assumption, we assume that the revenue is going to dramatically drop under all cases over the 5-year forward period. We would be shocked to see them have the same sales in the 5-year forward period, but who knows? Maybe I'm just being ultra conservative here, and some ultra ZIM bull is got the right idea somewhere. Our sales capital ratio, we have a pretty wide range of going from 0.5 to 3 on expected basis. We have 1.24 being the number that we see in a 5-year forward period, and that equates to returns on invested capital, a pretty wide range for that as well. But it is pretty crazy to see it drop from what was in the most recent year 75% to, if these assumptions were to hold, we would see them having about a 5% return on invested capital in the 5-year forward period. So a very, very poor return on invested capital showing, also very poor relative to their cost of capital as well. So that would not exactly signify a great business to be an owner of. And the debt to equity ratio we have for the company on expected basis, we see about 50% in the 5-year forward period. So we are kind of assuming actually that they possibly trim down the debt to equity ratio assumption. That's like the one way in which we're possibly being a little bit generous to them. But that's just kind of one thing that I felt was appropriate to do given the other assumptions in line with it. But that does still equate to a dramatic default risk. It does actually vary pretty widely with the assumptions, anywhere from basically 0 default risk in the best case assumption to almost 10% per year chance of default in the worst case scenario. But on an expected basis, we see about 4.5% chance of default per year for the next 5 years. That's per year. So if you annualize that up for 5 times, that equates to about 24.5%. That means over a 5-year period, that means you hold this stock for 5 years. And my guess is that there's about a 24% chance that the stock goes bankrupt during that time frame. So huge. That's just a huge amount of default risk. Profit margin assumptions, we have a pretty wide range of anywhere from 0.5, effectively 0%, to 7% on the upper bound. On expected basis, we end up with about a 4% net margin assumption. And that equates to profit assumptions of anywhere from 14 million in the worst case scenario to possibly 495 million in the best case scenario. On expected basis, we see $198 million in profit. So to go from 4.6 billion to 198 million in 5 years might sound like a pretty crazy assumption to have, but that's basically what we see happening. What is that, like 95% drop in profit or something like that? Which would perhaps explain why it trades at a multiple of around 1 currently on its profit. Anyway, we have a present value after adjusting for the discount rate that we have for the company and all the other assumptions therein of $56.49 per share,
which is 16% higher than the current share price. So yeah, that's pretty fascinating, if I do say so myself, to see a company with such ridiculously horrible fundamental future assumptions. I don't mean horrible in the like, oh my gosh, this business is horrible. I mean, it's going downhill. I mean that it's horrible and it's going downhill. The revenues go downhill, the sales capital ratio goes downhill, the returns of invested capital go downhill, the default risks go downhill, the profit margins go downhill. Like I said, the one thing that I'm not making worse for them is their debt to equity ratio. And imagine just how much worse their default risk would have been if I had increased their debt to equity ratio even more. Not to mention that would have increased the discount rate as well. So that would have brought the present value down even further. So it's like it's just crazy to see a company with so much hellish red right here still end up having a fair value assumption that's positive. But that's just, you know, how markets are sometimes. Again, it's trading at a PE of like 1. So it's like even if it's trading at a PE of 1, your earnings drop by 95%. That means your new earnings are going to be 1/20th of your previous earnings. That means you went from a PE of 1 to a PE of 20. See, so it's like you went from a ridiculous PE to a pretty typical mature, no growth and high confidence PE. Which that's not to say that that's what their PE will be in the 5-year forward period. In fact, their 5-year forward period PE will be probably more like 10 or something like that. But whatever, I'm not doing that part right here. But anyway, so continuing with it, I little digression there. But there are 5-year forward value targets unadjusted for the dividends that they will pay out from the company of anywhere from $50.32 in the worst case scenario to possibly $199.94 in the best case scenario. On an expected basis, I see about $99.05 per share. Compare that to the current share price, that gets us an implied return of 15.27% per year for the next 5 years. So all in, that's actually a pretty respectable return. If it was in a really, really good company with a really high quality business and great management and a relatively safe, secure business model, in my opinion, then that might be a low enough return that I would jump for it. It's definitely not high enough given some of these other factors, in my opinion. The value score is also not terrible, but it's not terrible partially because it has such high potential. But it is weighed down by some of the potentialities of it being pretty bad. It also is worth noting that the current share price is lower than basically any of the worst case scenario value targets I have right here, which basically means that even in a worst case scenario, it's basically implied that you're basically not likely to at least lose money. You're not really going to make money, but you probably wouldn't even really lose money in a worst case scenario. It just would probably be a really, really big waste of your time. So you would lose money on a opportunity cost adjusted basis, but in an absolute sense, you probably wouldn't even lose money. It just probably wouldn't be a very, very fun hold. And then that's worth noting, because now that I've kind of finished the valuation, I will make one other last comment, which is about this ridiculously high dividend and like what that would imply towards these returns here. Because as I had said before, a dividend comes out of your expected return. It's part of the expected return. It's not an extra part. It's part of this number right here. So if you see a 39% here and you don't see any numbers that are higher than 39% here, then you have to wonder how you're possibly going to be giving me a dividend while still also having share price appreciation, which is to say that you won't have share price appreciation. It means that even in this best case scenario, if they paid a 39% dividend all the way through, the same dividend all the way through the 5-year period, that basically means no matter what, the share price would have to come down. Now, they're not going to pay a 39% dividend all the way through. That's not what they're going to do. I had also said that earlier, which is that it's probably just the 1 quarter number, and then the next quarter after that, they'll probably drop it, and the next quarter after that, they'll probably drop it more, because they said themselves that they expect their dividend to be 20 to 25% of their net income. So if they expect their dividend to drop, this 39% is not a real 39%. It's really more like 10% for the next quarter, and then who knows, we'll see what it is after that. So anyway, that's basically going to do it for my valuation of ZIM Integrated Shipping. Very, very interesting company, considering the crazy chaotic industry it was in. In some ways, I was surprised to see that it actually had a decent value to it. Even though, like I said, it's not really that much of a surprise that a company that trades at a PE of 1 might be at fair value or something like that. The real question is that it's not a much better value considering that it's trading at 1, which goes to show that it has dramatic risks. That 4.5% default risk alone would keep me from investing in this company. I would not touch this company with a 10-foot pole with the idea that there could be a 24 to 25% chance of default just by holding it for 5 years. You would have to offer me a much better return than 15% per year for me to jump at that. So definitely going to pass on it myself, but considering how talked about this company is and how interesting it was on its own merits, I definitely wanted to cover it for the channel. So with that, I'll come back over to the watch list and kind of make some comments about what I have on the burner as far as for future evaluations. I've said it several times over the last several evaluations that I've been kind of waiting for Sandfire Resources to release their annual report so I could do their evaluation. They actually released a notice in the last couple of days saying that their annual report should be out within a week or so. So I expect to have that evaluation done at some point in the next couple weeks. At some point, I'm also taking a look at a few other companies. I recently made some adjustments to my screening spreadsheet that I had produced for viewers of the channel and in a free Google Drive, which you can find by joining the Discord. The link is in the description below. Which I haven't updated the actual spreadsheet in that Google Drive for everybody, but I've been working behind the scenes on updating my screening evaluation tool to make it a little bit better and a little bit more consistent as far as like how it pulls values together. But anyway, the point is I've been using said updated tool for my own screening process and coming up with several potential companies to value in the near future, of which ZIM was one of the ones that was kind of being flagged in that grouping, which is part of the reason I did it here today. But I'm expecting to possibly be doing valuations of some of the big banks here in the near future. I've been taking a look at JP Morgan as well as Citigroup and Goldman Sachs. The three of them I'm very, very interested in doing kind of a little bit of a group valuation of at some point in the near future. So you can expect those, as well as I'm also taking a look at AMCX, that being AMC Networks. That's been kind of sparking my attention and piquing my interest a little bit, as well as Stone Coal and a few others kind of listed in here, as well as I'm just kind of looking at lots of companies for potentially screening. So those are some of the companies that I've been potentially thinking about doing valuations of in the near future. If you have other suggestions for companies that you would like to have me value, you can join the Discord and send those recommendations to me via message or just in the general chat there, as well as you can also just put them in the comments below, assuming of course that you've liked the stream first and foremost. So with that, that's going to be it for the stream today. Like I said, I'm not 100% sure which one is going to be next. It's probably going to be one of those three banks of Citibank, JP Morgan Chase, or Goldman Sachs, but I'm not 100% decided which one will be the next stream, but it will undoubtedly be when we normally do our streams, which is this Thursday at probably around 2 p.m. That being the same time we started today. I have been shifting around my stream times a little bit, but I think I'm kind of leaning towards doing this more afternoon time frame, 2 p.m. time frame for now. So I'll catch you all again next time. Bye.